Cool. Well, John, thanks for being here. Everybody who's on, thanks for being here. This is obviously going to be really, actually, it could be life-changing for folks, John. The
Oh, yeah.
amount of questions I get from our investor community at SuGo Capital about the topics we're going to talk about today, it's like nonstop. So I'm going to jump in. I'll talk logistics, introduce the topics, take your time having some drinks, and then I'll take a few minutes while you finish that. So first of all, everyone, if you haven't printed out the worksheet, a lot of people, you come to these things and you watch, but then what do you do afterwards? Like, you don't remember the specifics. People email me and say, wait, what were the steps I was supposed to do? So Cynthia, if you want to put this link in, it came to everyone via email. But this is really exactly what we're going to do today. It's very simple. Sorry, one sheet. But this is what we're going to talk about today. How to reduce your taxes when you're doing a Roth conversion. The 5 steps to discounting. John might have more, but if you simplify it, could be 5. We're going to talk about some actual use cases and examples. So the next item is a website where you can find investments to use with this strategy. And then John's also going to talk about the best entity to use when investing. Now, of course, there's not one best entity to use. He's going to talk about entity structure and strategy when investing. So I have a line there. So you can take some notes based on what you hear from him, what's best for you. And then there's 2 more boxes. My next step this week is 2, because a lot of times people go, oh, I'm going to do that. Like maybe I'll do that over Christmas break. And then you forget about it. So I really encourage you all, because we're all here, right? There are, I think, John, I got up to 1,600 people who registered for this. So you and I are here for the next probably hour and a half. Everyone else as well. So you guys make it worth your time and pick one thing at the end of the presentation that you're going to do this week to start putting into action some of the things that you hear today, at least to learn more about them, to know if they're right for you. So that's what we're covering today. Hopefully it's relevant to you. So you're in the right place. If you have an IRA, and you're thinking about doing a conversion, you're in the right place. If you invest outside of the stock market, you have some private placements, you're wondering how to hold them. You're probably not in the right place if you don't have any retirement accounts and you don't invest. Although maybe this will be good, because maybe it'll change your mind about some of those decisions, and you'll start doing, you'll open an IRA and start investing outside of the stock market. But why am I having this specifically? Why am I hosting? So SuGo Capital, we are primarily a real estate investment firm. We have other opportunities as well in oil and gas and hedge fund, but we do a weekly investor Q&A. And anyone from our community is able to come on. I know John used to do these sort of things, and we kind of picked it up from him that it's a great idea. It builds community, thoughts, best practices. And we heard so many great use cases from our investor community who had used the strategies that John's talking about. And of course, everyone said, well, we learned this from John Hyre. So then as they talked about it, then all the other investors were like, Sarah, can you tell me more about that? Sarah, can we use, this open investment you have, this open apartment syndication? Can we use this one in that strategy? I'm like, yes. And they said, what are the exact steps? And I said, I'm not the expert. I should not be answering these questions. I'm going to bring the expert on. So that's John Hyre. Most of you know John Hyre. If not, he is not self-proclaimed, but proclaimed in the community as America's finest. Like, seriously, guys, anything having to do with IRAs and taxes, John is like the person who it comes out of their mouth. Like, John Hyre, like, you have a question about that? John Hyre. You go to all these network, and John Hyre is like the one. IRAs, taxes. It's a real honor to have you here, John. And we have so many people in our community who are just like banging down the door. They're so excited. Audience, we are recording. Everything's recorded. You'll get a recording. You can share it with whoever you want. We'll send you links to whatever John's going to talk about. So the replay email is going to have all the resources for you. So you don't need to ask in the chat, can I get a replay? Can I get a replay? Just watch your email. You'll get a replay with all the resources today. All right, with that, John, go ahead if you'd like and introduce yourself, and let's get rocking, because I know you have a ton of information to share.
Okay. It says sharing is not turned on, which given
Well,
how
let me turn it
is
on for you.
normal.
That would be
Yeah, that's what I'm known for, caring, sharing.
There we go.
Let's
Should
see
be
if we
good.
get that on there, and then we'll do a wee little chat and we'll get right on. So for those of you who haven't heard of me, well, okay, fair enough. I'm very well known in a very, very tiny, 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 tiny little sliver of the world. But I'm a tax attorney. I reside in Puerto Rico. Hopefully the Puerto Rican internet behaves. I have 2 backups, but it's still Puerto Rico. So I'll come back if I go away. I
Okay.
do a lot with real estate investment. I do a lot with self-directed accounts, whether it's 401ks, IRAs, rollover business startups, which are one of my favorites, and we're going to talk about. We're going to cover today primarily discounting traditional to Roth conversions. We'll get into what that means. It's super valuable. If you do anything with retirement accounts, you really want to know about this. It is financially life-changing. For some people on the call, it will be 7-figure tax savings. For most of you, if it's not 6-figure tax savings, you're really not trying, and it's just so very sad.
100%. I want to reiterate that, everyone, because our investors in our community use this and they tell us the numbers, and it's like, wow, we got to get more people on board.
And I love what I do. I mean, so philosophically, you may have gathered if you follow me on Facebook and didn't delete me or block me immediately, which some of you probably did with reason. I am not a huge fan of the federal government. I still believe we should follow the laws. And so I try to use their rules against them to keep the money where I think it belongs. I like entrepreneurs. I do not like the federal government. So I will do whatever I can legally and ethically do. I also enjoy the chess game. So there's the whole, I don't know, I guess I get the dopamine rush. Like instead of video games, I just do that. And then finally, there's of course the pay component, which is sort of relevant. So that's what I do. I'm a tax lawyer. I've been at it for, have I hit 30 years yet? Let's see. No, I hit 30 years next year. I'm 29 years of experience and worked for the man for about 7 years. Large oil company you would all be familiar with as tax counsel. Went out on my own and focus on this. The second half of the conversation is going to be some basic asset protection pointers. And I'm going to do as much as I can, especially knowing a lot of you are from California and the evil people from Nevada, Utah, Wyoming target you. And we're going to talk about that targeting and what to do about it. I would vote largely ignore and avoid, but we'll get there. So with that said, questions. There's a questions box there. There are 2 women here to boss me around. Hopefully they stay consistent. I've been well trained to be bossed around by a 5-foot-tall Chilean with an accent. Sarah lacks an accent, but she also lacks a Y chromosome, so she still qualifies. But until she
qualified
tells
to
me,
boss you around. Excellent.
yeah, no, she has drilled into me, obey. And when you're dealing with a 5-foot-tall Latina who explains to you, and I'm dead serious, by the way, this Lorena Bobbitt, she was an amateur. They were able to fix him. They will not be able to fix you. All right, it's kind of like gets your attention, you know. I wake up in the morning and I don't look to see if I'm alive. I just want to know I'm complete. It's going to be a good day. Chileans happy. So I just obey the non-Y chromosome people. That's what I do. You'll see that just slavishly. All right, let's get on to the presentation. Enough about that. Very briefly, this is educational. It's not legal advice. Legal advice means you're giving me $2,000 an hour if I were taking clients, which I'm not. My time was essentially, simplified version, bought by a large family office for a lot more than what I charged, which was $1,000 an hour. So there's that. This is education, which means if you try it without having an actual tax professional look at it, you're probably going to win a financial Darwin Award. Note, that is not a good prize. It's just stick with the participation trophies. That's sort of even, right? 0, Darwin Award, negative, bad, don't do. So talk to a true professional before attempting any of this. And just in case you missed it, yeah, I'm not woke. I don't care if you're easily offended. It's not my problem, right? Your personality issues are not my problem. They're your problem. This is your warning. This is not a safe space. I will say what I feel like saying. And if you don't like it, you were warned. Now, Sarah makes me somewhat behave, so I'll be mildly civilized. Eye roll. All right, discounting traditional to Roth conversions. Let's go right at it. Here's a normal approach. And again, I'm skipping some context. So without getting into it, because we only have X amount of time, Roth is way better than traditional. Roth is tax-free, but you have to put after-tax money into it. It's a good trade-off, right? If that's the sole trade-off, I don't get a tax deduction for putting money in. I put in after-tax money, but I'm doing private investing, and we live in an inflationary environment that's going to get a lot more inflationary, then you really want tax-free. Putting in after-tax money, I would mark the number, and I'm just guesstimating here. Normally, I do an actual spreadsheet and analysis and so on. Roughly right around if the internal rate of return, the rate of return inside the account, the IRA, 401k, whatever, is 12% or greater, it's just a no-brainer. It doesn't even matter what bracket you're in at that point. It's a no-brainer to do Roth IRA tax-free instead of traditional, which is tax-deferred. What's the problem with traditional? You pay the tax later, you get instant gratification, which Americans love, and you pay the price way in the future, which Americans also love, except when the future becomes now, and then maybe not so much. The problem is when the future becomes now, you're paying on nominal gains, not real gains. So if you're making, let's say 15% and the rate of inflation is 8%, the real gain is 7%, you pay on 15% compounded at whenever it is you pull money out of the traditional. That is not optimal. I really would go for Roth. We want you to have your cake and eat it too. Or better put, we want you to eat your cake and yet still have it. And so here we're going to give that approach. So what's the normal approach on a conversion? You contribute, I'm making up a number, 100 grand. Engineers, software people, don't get all bent out of shape. It's a number for easy math for the normies. I don't need texts on, I can only put $75,000 per year. This is wrong. No, me does not compute. No, calm. Quaalude engineers, Quaalude, calm. Round numbers for normies. Contribute 100 grand to the account if it's a traditional account. You get 100 grand deduction. We like that part. Let's say you convert 100 grand to Roth, whether it's cash or marketable securities that have a clear fair market value, or even gold, which has a clear fair market value. You convert at 100, it's a wash. I got 100 grand deduction, but what happens when I convert the traditional to Roth at 100 grand valuation? Well, I add 100 grand of income to my return. So it's a wash. And by the way, again, all things being equal, assuming you're in any significant bracket, that is a good deal. Roth is better than traditional for most of you. I don't know you well enough to say if it's good enough for you, but for most of you, it's better. I want the best of both worlds. So I want to get a 60% discount. So let's skip to the end. Let's do the spoiler. Here's the result I want. I want you to put 100 grand into a traditional account, get a $100,000 deduction, convert all $100,000, get a 60% legal, 60% discount on the conversion, and only report 40,000 when you convert to Roth. So you have 100% Roth, the whole kit and caboodle, the whole 100 grand, and whatever it grows into, more importantly, is Roth. But I want it to be, in my happy world, and we'll get into the numbers, 60% pre-tax, 40% after tax. But there's a methodology for doing that. And excuse me, I'll be coughing a bit. We got the Sahara dust storm here. It triggers the sinuses. My voice gets gravelly. I drink, it gets more gravelly. It's what happens. So how do we get the discounting? We're going to borrow concepts from the estate planning, the estate tax world. And there's case law that says estate and gift tax concepts, especially when it comes to discounting, generically apply in the income tax world. Well, converting, whether at a discount or not at a discount, from traditional to Roth is an income tax issue. So we're bringing estate and gift tax ideas into the income tax world. Whoops. Oh yeah, no, I think this is the right one. Okay, yep. This was just I thought I was going to put the first point at the end, but I'm going to say it twice because I really want you to hear it. That's why it's there. Blew me for a second away, so I had to have a drink, and here we are. Talk to your custodian ahead of time. See if they'll even allow this. Most self-directed custodians do allow it. Most of them have procedures. You want to know the procedures ahead of time. So ask your custodian, do you allow conversions? And most of them, once you explain what it means, usually they know what it means, a discounted conversion from traditional to Roth. And I'll give you the basis of explanation. You can hand them the slide deck. I don't really care. They will have a procedure. Usually it is you get an appraisal, you hand them the appraisal, they process the appraisal. Usually it's pretty simple. Now, the key is do it on time. This is not something you want to wait till the last minute, because I know I don't do this, but some of you procrastinate on admin tasks, especially the entrepreneurs. This is not something really to procrastinate on. I would get the appraisal sooner rather than later, because I have seen it occur where you talk to the appraiser late in the year and he or she is just so busy, they can't get it in time for the custodian to issue the proper paperwork. So watch out for that. Typically, we're seeing appraisals run about 1,500 to 2 grand. So size does matter, right? If you're converting 10 grand, is it worth paying 1,500 for an appraisal? Probably not. If you're converting 100 grand for a nice fat discount, is it worth 1,500 to 2 grand? Oh, heck yeah. Heck yeah. This is gray. This is gray, which is, by the way, where I play, right? Black and white law you can get on the internet, and we'll talk about the problems, the virtues and vices of the internet, not including porn. Sarah said I can't even use the word, which I did, so there we are. But anyway, the internet has weaknesses and strengths. It's good on black and white stuff. The gray, the internet is not so good on, and by the way, that's where most tax planning occurs, because the law is not always clear. Well, this is one of those cases. So what I'm telling you is gray. If you use it, is there a chance it won't work? Yeah, and in fact, I'm going to give you some percentages later on, just how I view the thing. Let's start with an example. We're going to start with the genesis of this, gift and estate tax. Now, for those of you who understand at all, even 101 basic gift and estate tax law, what I'm about to tell you is hyper 101. In the gift and estate tax world, what I'm describing is absolutely routine. We're just going to move it into the income tax world. So let's start off. If you have gifts, you give gifts to your kids or to whomever it is you like if you don't like your kids. And by the way, if you don't like your kids, that's probably a you issue. I'm just saying it happens, but you have kids, you want to leave them things when you die. Sometimes it makes sense to gift them assets, but there's a limit on how much you can gift. There's a limit on how much you can gift without paying a steep tax. So the basic way to gift, if there were no limit, let's say I have $300,000 houses. I have 3 kids. I love them equally. Okay, discussion for later after drinking. I give each one of them a $100,000 house. So the gift to each kid, it's total $300,000, $100,000 house each, multiply by 3, 300,000 of your gift and estate tax exclusion has been used up. And if the exclusion were unlimited or you weren't anywhere near it, you would just do this because it's easy. But sometimes you want to preserve that gift and estate tax exclusion. So what's a better way to do it? To reduce the amount of the gift. We want the gift to be smaller. Well, we form an LLC. The parents own 1% of the voting stock. Now, I can tell you, if I own the voting stock in an LLC that my kids have the other ownership in, and they don't have any votes, I'm going to be an absolute parental fascist. Oh, daddy, but I love him. Oh, sorry, no distribution. Ha, ha, ha. Have a nice day. So normal. I have control. The kids don't have control until I die. If then, I might even use a trust to retain control just in case, like they marry someone who votes the wrong way. I'm not going to say what that is. You might be able to guess, but if someone who votes the wrong way marries in, done. Can we do that after we're dead? Oh, absolutely. Great fun. Great fun. I think hopefully in my last 30 seconds actually of life, that'll be something of what I'm thinking about, just that sort of evil. So I have control over the thing. The kids have 33% each of non-voting stock. We then contribute all 3 houses. It's still the same fair market value, 300 to the LLC. So we form the LLC, contribute the houses, parents own 1%. There is a decrease in value of the stock. Let me ask you this, just knowing me, some of you have only known me now for a few minutes, and this is really before the alcohol even kicks in and makes me nicer. How many of you would like to buy into a company over which I have complete control? I am the just untrammeled dictator. Sound like fun? Okay, now let's just substitute. Now, some of you are like, yeah, actually, we think you would dictate well. Like you have the bumper sticker on your van that says out of work dictator looking for small country to run, sign him up. But how many of you want a dictator in general? Generally, when you invest in something, you want to run it. The law recognizes this. Under state law, if there's a lack of control, in this case, because the management is absolutely vested in someone else, there is a discount. We start with the value. This is hard for some CPAs to grasp. Not all, not cracking on CPAs. Trust me, I'll crack on lawyers. They deserve it more. we start with 300 grand of fair market value. Under tax law, not common sense, not logic. Let's never confuse that with law. Under tax law, we get a discount for lack of control. In other words, what we would think the LLC is worth 300 grand and a third interest would be worth 100 grand. But lack of control gets us a discount, typically of 20 to 30%, meaning it's really only worth 70 to 80 grand, not 100 grand. Why? Dictator. So next, take a look at the second bullet point. The operating agreement makes an already illiquid investment. I mean, who wants to buy into a closely held entity? You don't know these people, or worse yet, maybe you do know them. It makes you even less want to buy in. But bottom line, closely held entities are oftentimes an awkward thing to buy into. They are by nature, for a number of reasons we don't have time to get into, inherently illiquid. Oftentimes, the operating agreement will make an illiquid investment less liquid. Rights of first refusal, unanimous votes to admit members, etc. Once again, illiquidity under tax law creates a discount. So lack of control and illiquidity. And by the way, both of them range from about 20 to 30%. So you start with the value. This is important for the CPAs because the CPA's response is, it's worth 300. No. There's actually tax law. It's worth 300. No. There's actually law that says we get a discount. It doesn't have to make sense. It just has to be law. And it does make a certain sense when you explain it the way I did. But you'll run into that some. You're going to run it. I've seen it. I've gotten calls and emails, and the CPA says, you bought the securities for 100. They are worth 100, period. I'm not signing this. Okay, you're fired. Well, let me try and talk to you first. Let's see if you are amenable to reason and can listen. Most of them do, by the way. Most CPAs actually are pretty good and want to help, and most of them will listen. There are a few that, not so much. So bottom line is lack of control, lack of liquidity, create a discount under tax law. When you combine it, it's a 40 to 60% discount. Now, this is under gift and estate tax law. So there we go. They said, say it. What is it? Tell them what you're going to say. Say it. Then tell them what you said. Well, here it is. Here it is. And by the way, I've seen larger discounts than 60%. There are other factors I don't have time to touch on. For example, family discord or a key operator in the business who is not bound to the business are examples of where we can actually get more than a 60% discount. So there are other things to look at. The bottom line is here, fair market value, 300,000, 60% discount, 120 fair market value of my gift and estate tax exemption used. This is 101. This is not really, I mean, there are some details as to how you do it that we don't have time for, but this is not a controversial topic in gift and estate planning. This is common. But we go to income taxation.
I'd like to make a comment on that last slide, John, just to say, so at SuGo Capital and most private investment firms, these first two bullets are really important. You don't have any control if you go into a fund or a syndication, an oil investment, hedge funds, and a lot of times you don't have liquidity or there's an extended lockup period. So, a lot of people ask me, oh, is it just for syndications? I want to point out, it can be a lot of different kinds of investments. It can be a lot of different kinds of funds and private investments where you just don't have any control or you don't have liquidity. And so the range that I've seen for our investments is 40 to 60%. It's fantastic. So I just want to point out that there is a huge range of things that can fall into this category based on those two first bullets.
And that's why it's a topic we love to hit. I know your people are buying into deals where this is a thing. In fact, I can't tell you the number of emails I've gotten saying, I wish I would have known this 20 years ago.
Right.
Because I've been investing in private investment forever and a day, and I've been missing out on this the whole time. Yeah. Well, sorry, I was busy.
And I didn't know about it earlier, but now what we're doing is if there's enough people on each deal who want to do this strategy, then instead of 10 people running over to a CPA and getting the appraisal, we can say like, hey, we got 10 people who want to, do this strategy. So for those of you who are from SuGo Capital, you're in our community and you're going into Zocalo, if you want to do a Roth conversion using Zocalo, it completely works in this strategy, and let me know and we'll coordinate an effort so that, you know, the $2,000 instead, maybe, you know, we can get it down to 8, 5. I've talked to some different people.
Cool.
Cool.
And for all of you raising your hand and wanting to ask questions, we have very little time. With all respect, we are not interrupting the conversation. Otherwise, this will go forever. Don't get me wrong, I would enjoy that, but it's just not what we agreed to, and I have to actually keep my word. I only lie on the clock. That's a joke for our NSA overlords, by the way. Good Lord. I mean, nobody has a sense of humor anymore. So shifting to income taxation, I'm going to start fast forwarding through this just more for the tax geeks. This is aggressive. There is case law that says specifically discounting techniques apply in the income tax world, but there's no specific case law saying it applies on a traditional to Roth conversion. That's what makes it gray, right? If we had a case, it wouldn't be gray. We don't have a case. Why don't we have the case? The IRS hasn't gotten around to it, or they don't like their odds. What do I think the odds of winning this are? This goes to tax court. I think we got 65%. Why is that important? In order to avoid penalties, and again, I put some word there for the geeks on the call who are accountants or know what 66, which is appropriate, 6662A penalties are. The way to avoid those is to have what's called substantial authority, which is a good argument. What's a good argument? 40% chance of winning. I think we're way past that. Now, could I be wrong? Sure. I don't think I am, but could be. So here's the procedure. Here's the step-by-step. You contribute 100 grand to a traditional pre-tax account. You get 100 grand deduction. You invest 100 grand traditional pre-tax money. This is important. This order is super important. In a private equity deal, I use the term loosely, a syndication, a PPM. Usually you're a member of an LLC or you're a member of a corporation. So it's not debt, it's equity of some sort, and it's private. You invest and you don't convert before you have invested. I've seen people convert and then invest. Doesn't work. Once you've invested, you convert to Roth ideally when the fund closes. Now, some funds don't close, or they close too far in the future. What do I mean by that? The fund no longer takes money. Because the IRS has a superficially attractive, I think it would lose, but I prefer to avoid arguments even if I'm going to win them. So I like winning arguments, but I like avoiding them even more. By the way, great marital tip, follow me for more. The best fight you've ever had with the IRS is the fight you never had. If the fund closing date, when they stop taking funds, is not that far into the future, I would use that date as the conversion date. Why? Because there's a superficial argument of, well, you put 100 in, it must be worth 100 because you put 100 in. And that's superficially appealing until you look at the law. That's what the CPAs and so on give me. So if I can take the facts and make it that that's no longer the case, no one is paying 100 grand anymore to put money in, that's the conversion date I'm going to choose. If what? It's a realistic date, and that's subjective. Otherwise, when am I going to convert? Right after the contribution. Because the longer you're in the fund, the closer you get to what? A liquidity date and a control date. So every day that goes by, your discount theoretically reduces. Now, as a practical matter, for at least the first few months, there's no real reduction. What's the other reason to not wait too long? You want the appraiser, if you want a cheap appraisal, you want the appraiser to value the discount and only the discount. You don't want them to value the asset. Look, I put in 100. I'm going to grant that the initial value of the asset is 100. I don't want you to appraise that. I don't want to pay you to appraise that. I want 100 value on the asset. I just want you to value the discount. That is easier and therefore cheaper for them to do. So if you do this years after you've invested in something, you probably will have to pay them to value the asset in addition to the discount.
So I want to reiterate that because we've had a lot of people say, can we still do it? I'm just learning about this now. Can I still do this on a syndication I invested in 2023 with you, Sarah? And so the answer is yes, it'll just be a different financial scenario than what we're seeing on the screen right now.
And I think oftentimes you want to talk to the appraiser ahead of time.
Yeah.
Hey, what's your gut feel? Especially if they know they're getting more than one of you. That's where, if it's a group of you, you've got more leverage. We want a sense of what's the range of discounts without you making any binding promises. So you have a sense of, is this outcome that's being somewhat predicted worthwhile? So super important. You then obtain an appraisal, generally $1.5 grand to $2 grand. I've seen much better deals for bulk deals. And they're only appraising, again, the discount, not the asset. You then give this to the custodian, if it's an IRA, HSA, or a Coverdale Educational Savings Account, or to the trustee if it's a 401k. You provide them the information. Now remember, what's the slide that we had up first? Figure out, will they even do this? Most will. And what is their procedure? Follow that procedure. It's usually pretty easy. Now here's the beauty. Number 6, you get a form, a 1099-R from the custodian or trustee saying what the correct conversion amount is. Why is this important? IRS and bureaucrat psychology. The form has a number. You reported the number. At initial glance, they have no idea how you came up with that number. They don't know if they like or dislike or care about how you came up with the number. Now, I'm not saying that so that you can just go do whatever you want, make up a number. That's not what I'm saying. I'm just saying, once again, what's the best argument you ever had with the IRS? The argument you never had. You've got a form. They tend to be very form-driven, a 1099-R with a number on it. You report exactly that number on your 1040. Skynet is not triggered because the numbers match. And an agent probably wouldn't be on first glance. They would have to look deeper to even understand what happened, which I think is legit, much less whether or not they disagree with it and what they're going to do about it. So that form for me is a key piece of the psychology.
I have a
Result.
question, John. I didn't see anywhere in your steps that they need to coordinate with the operator or the fund manager to make any change, like on the subscription paperwork or.
You know, that's a good one. I'll have to add that one. In fact, if you have a textable moment, remind me and I'll add that one. That's a good one to throw in there because there does need to be a title change name. Technically, especially if you're dealing with IRAs. With 401ks, you can argue it's the same account. It just has 2 components, one traditional, one Roth. But I would still want to make a notation. But you're right, definitely with IRAs. Definitely with IRAs, you want to convert from traditional to Roth. That means there's a separate account. Those are 2 different accounts, at which point there does have to be a title change. So what do you ask the syndicator ahead of time? Will you do this? That's a great point. By the way, I think I know your answer.
Yes.
Yeah.
Oh, wow. Now you have more money to invest with us. We will do that for you.
Enthusiastically, cheerfully.
Yes. And you know, some people don't because there's a fee, but you know, oftentimes we have a legal fee associated with it and some effort, but it's worth it for our investors. So I want to point out 2 things because I get these questions over and over again, John. So when you guys are writing down, what are the steps? John went through the steps, but really the first 2 steps are ask your custodian and ask your syndicator, the operator of the investment you're going into, and then do all the technical steps.
Yep, I'll add that. Good point out. See, this is why the non-Y chromosome crowd gets an extra say. This method, now what is it? The madness has a method to it. So final result, typically a 40 to 60% discount. I've seen more, as I mentioned, in a key man or a diversified business or owned by a C Corp, because a C Corp on its own, because of the extra layer of tax, will create more discounting. And I've also seen lower. I got into a highly liquid hard money lending fund that we didn't really get much of an illiquidity discount because it was so easy to get out. So I have seen it vary, but this is generally the pretty good range. And so going back to the example we started with, $100,000 deduction from having contributed to a traditional pre-tax account, 60% discount means you're only reporting 40,000 on the Roth conversion. All 100 grand or whatever it grows to is Roth, but 60% of your Roth was pre-tax. That's a highly abnormal and glorious result. That is eating your cake and having it too. I will move based on the interests of time. So remember your questions. I'm sure it's being tracked. I'm going to move into entities. And knowing that a lot of your people are from California, I did tailor it a bit around this. You'll even see it in the first line.
Ooh,
right off the top.
May I interrupt before?
It's the only way to get a word in, you know this.
So you guys, we finished that first section, then there's a line. If you want to do this, how do you find, you need an investment in order to do this, right? So I see people in the chat, yes, add me to the list. How do I find investments to do this? You can write this down, sugocapital.com/open. That's where you will find, we do this as a sponsor or operator for all of our investments. We are okay and familiar with this strategy. So sugocapital.com/open, you'll always see what we have. And this strategy works, the discounting strategy works with all of the investments we offer. And then if you specifically want to see one that's open right now, that is going to be really good for this, is sugocapital.com/spicy. It'll ask you for some information. SuGoCapital.com/spicy. And that's one that's going to be particularly good for the discounting strategy. All right, on to entities. Thanks, John.
You bet. Can't just chug this wonderful bourbon. It's very good when I'm drinking. We have to have our Kentucky Chew.
And I'm over here having tea, in case anyone's wondering.
Oh yes, I'm having tea. No, the smile is too broad for tea, fooling no one. All right, let's start with what's the problem with the internet? You look at the AI such as it is, and let's say it's biased in one direction. Why would that be? Well, there are two reasons. One is when it's overt, right? Google, in order to have, when you say, show me a picture of Nazis, and it puts people who are not, let's say, blonde, white Aryans in there, that was programmed. Somebody told it, we want you to be super diverse and woke, and that's how you get, essentially, Black Nazis. That's not most of AI. Most of AI's flaws come from the fact that the internet is an idiot. The internet is a sum total of what's out there. AI does not know how to distinguish, unless you prompt it well, between quality content and mere content. It just picks up a bunch of content. And so whatever the biases of the internet in general, AI is going to pick that up, whether you like the bias or you don't like the bias, or you don't think the bias exists, which probably means you like it. It is the same in taxes. It's the same with asset protection. If you search for asset protection topics on the internet, what are you likely to get? What's the vast majority of the content? Somebody trying to sell you something that is too good to be true, costs too much, almost certainly being sold out of Nevada, Utah, Wyoming, to a lesser degree, Delaware. That is the internet for asset protection. Be aware of that. So much of the content out there, and therefore, so much of what you ask ChatGPT will be driven by information that was designed to sell you things that are probably not really very good for you, as opposed to knowing how to screen for good information. This is a kissing cousin of the free seminars. I have been practicing on my own now for, oh, let's see, 22 years. And I have had to fix, when it was fixable, many sad times it was not fixable, messes created by the Nevada, Utah, Wyoming crowd. A great example would be a C corporation when you didn't need one. They just included it in the structure because C corporations, and by the way, that's very common, that they don't ask you anything about you. They don't know anything about you. They haven't looked at your returns. They haven't asked you about your future plans, but they have a C corporation, usually as a management company or some such, somewhere in your structure. That is instant malpractice. If you're an actual attorney or actual accountant providing actual advice, just instant malpractice. So you have to watch out for some of these things. The usual MO for these people is they provide free seminars, lots of them in California. It's so much money and so close, right next there, right next to Nevada. There it is. Drive over, sell stuff to the gullible. I mean, nice people in California. I'm sorry, but a lot of you have fallen for it. What's the seminar pitch? Lots of fear. So they build up. I mean, look, yes, the country is not perfect. And yes, we have problems. And yeah, I wish there were less litigation and regulation and so on. And so there are things to guard against. These guys just grossly multiply that because they want you afraid, because then they can provide a solution. It sounds like the government. Let's cause a problem, and then we'll give you a solution that doesn't really work well, but costs a lot of money. That's essentially the model here. So they give you excessively complex solutions, large, complicated structures that cost too much money, and they usually sell it based on, well, this is what the rich do. Well, okay, if you're rich, that might make sense. But let me tell you something. You, A, don't want the fees the rich pay. And a lot of what they're planning constitutes is not for someone that's not in a very, 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 very well-off situation. And again, if you are awesome, maybe it makes sense for you. You still need to customize it. Usually there's a bait and switch. Usually the upsell, and there's always an upsell, right? Nothing's truly free. They're taking your time. The upsell is we give you lifetime support for an unlimited number of entities. Yeah, from someone who is, shall we say, mentally challenged, inexperienced, and relying on templates, to put it politely. In other words, the really smart guy on stage who seemed to know what he was talking about, you never get to see again. You get people who probably don't even make minimum wage, or at least based on what I've seen them do, shouldn't. And it's templated. And that leads to disaster. That is not a cheap thing. So I've spent 20 years fixing this, guys. Watch out for those guys. Nothing's free. There's always a price. I prefer a stated price. I want to know what I'm getting. I want to know what I'm paying. I don't want a hidden price. You take my time. You give me things I cannot execute on. You do an upsell that if I'm dumb enough to buy, probably is going to result in an inferior product. And that has been my experience, lamentably, with that crowd. I'll give you an example. One property per 100% owned LLC. So you have a bunch of single member LLCs. Maybe you own them. Maybe your holding company owns them. Doesn't make a difference. We want to have, if you're a real estate investor, one property per LLC. Why? Because if you're sued on that property, all that they can take from you is that property. And by the way, we are going to use equity stripping to drain that LLC to make sure there's not much to take. So we're going to make you bulletproof and we're going to protect you super well. Excuse me, sinuses. So we're going to protect you super duper well. Too good to be true. It doesn't work that way. People, LLCs are like a bulletproof vest. In combat, they're better than a cotton t-shirt. Kevlar and plates work way better than cotton. But if you get shot in the head, you still die. All human things have flaws, all of them, including LLCs. In fact, the attempt to convert a limited liability company into a no liability company, which is what these people do. If you're getting the vibe, it's too perfect, man, we've got you covered. We're going to make fake loans to this company, and we're going to have one LLC per property, and we're going to find ways that if they sue you, they're just not getting anything. That's not going to happen. That's going to blow up and backfire. Little pigs get fat, big hogs get slaughtered. Don't be the big hog. Most of you, let's say you do have one entity per property. And by the way, it does make sense when the properties are quite large. If you have $1 million plus of equity per property, sure, one LLC per property. Why? There's a lot to protect. What's a prerequisite of asset protection? Assets. $1 million is a good bit to protect. It's presumably producing a good bit of income. So you can afford to what? Delegate the maintenance to somebody who knows what they're doing. These entities are like children. They're fun and easy to create. And there's a lot of work once you got one. Same thing with entities. There's maintenance required. For example, my opinion is that if you have no bank accounts for your entity, I'm going to pierce it pretty easily. An entity is a financial person. It needs to be able to conduct business. It cannot conduct business without a bank account. Oh, but the nice man from Nevada said if I have a management company that pays everything on behalf of the entity, that's really good enough. And it's so much easier. I love this answer. It's so good. It's also wrong. It's just plain wrong. You can have a management company. It's a separate conversation that another time and place I'll cover in detail. But there's a lot of effort involved having a management company. They never point out the amount of work because I have represented management companies in front of the IRS. And I've read case law where someone who had a management company was getting looked at by creditors for piercing, and things did not go well. Management companies can make sense if you're large, and especially if you have employees or contractors that are not you, and you're willing to do the work or pay someone to do the work. Maintaining a management company is a bunch of work, but this superficially appealing idea of I have this other company and it just pays all the bills for all the companies is a big mistake for most of you. It will reduce the asset protection. It will destroy the financial uniqueness or independence of the entities. Plus, you won't run the management company correctly. I've seen it too many times. Take a look at the third bullet point, due to, due from, or intercompany accounts. No, just no. No, not for asset protection, not for taxes. What do I mean by that? I have LLC A and LLC B. LLC A has money, LLC B wants money. So LLC A pays the bill for LLC B, and you create an account on QuickBooks saying, oh, company B owes company A money. No. You are destroying the independence, the separateness of each entity. The proper way to do it with LLCs, it's a bit different for corporations, is a distribution from LLC A to the owner, presumably the mutual owner, the holding company or the human, a distribution from company A up to the owner, and then a contribution from the owner to company B. And that's how it would show on the QuickBooks. This is, by the way, much easier if all three entities, so A, B, and the human or the owner, have the same bank. Much, much quicker if you have the same bank. If you have different banks, that could get really messy. I've been in tax audits where, without getting into this, for the geeks on the call, I'm talking about outside basis, and especially outside basis in an S corporation. For the normies, don't even Google it. It'll just hurt. Just trust a nice lawyer. I'm not on the clock. I won't lie to you. The issue of due to, due from accounts or intercompany loans in tax audits, and which company is being audited and which one actually deserves the expense, has been a problem in audits. So these due to, due from, and intercompany loan accounts create both asset protection and tax problems. Don't do it. If you want to have, and there's a whole list that we don't have time to get into of how to properly maintain a company. You have to have bank accounts. You have to have, excuse me, again, the sinuses. You have to have solid QuickBooks that match the bank statements. You have to have good overall business records, meaning resolutions, annual meetings, et cetera, et cetera, et cetera. There's a list. That takes time and effort. You don't typically have the time to do that for 40 LLCs. Now, if you do, it's because each of the 40 LLCs has a $2 million net equity property, and you're getting a bunch of income, and you can pay a team of people to do all the admin work that I know you hate and is low value work compared to what you normally do. So that's the key. If there are assets to protect and income being produced, more entities may be worthwhile. In fact, let me reiterate, judges are increasingly piercing perfect entities that are bulletproof, meaning they don't leave anything on the table for creditors to get. Give the dog a what? A bone, but not the meat. The object of a limited liability company is to limit your liability, not to eliminate it. The only way I've seen LLCs legitimately and successfully, consistently eliminate liability is when an LLC goes broke by accident. That's what they're designed for, right? If an LLC goes broke on purpose, well, I sucked all the money out with fake loans and distributions, and I moved houses when I knew there was a lawsuit or whatever. I made it broke on purpose. I didn't contribute much to begin with, known as thin capitalization. The courts look at that and they don't like it. In fact, it can blow up in your face where you might have had some asset protection. The judge might be angry enough, and I have cases to prove it. They go through everything. They go through everything. You got to leave something on the table. Now, if the company went broke by accident, look, I set up an LLC. I'm just making up a number here. I funded it with $1 million, and the business just went straight into the basket. It just went to hell. It lost money, but not on purpose. Well, you have asset protection, almost certainly. That's what they're designed for. So watch out for that. Take a look at the last bullet point. Nevada, Wyoming, and Delaware entities. All right, do these three states have better law than your state, especially if your state is California? Yeah. Yeah, everybody has better law than California, even New Jersey. Sorry, but true. Does having an entity in Nevada, Wyoming, or Delaware fix the fact that California has bad law when you're doing business in California or subject to California's jurisdiction? With rare exceptions, and I mean super rare, we're talking way less than 1% use case. Exceptions, having an entity out of state does not help you if in-state law is bad. Here's a hint, and again, I will take in another time and place a half an hour to explain it. When does an out-of-state entity make sense? Generally when it's a holding company. All it does, it has no activity. It just owns personal property. It is a holding company and it owns solely personal property. You may then have an argument that Wyoming or Nevada or whatever law applies. If that's not the situation, the odds of Nevada, Wyoming, or Delaware law applying are extremely low. Be aware of that. Don't overcomplicate it. I know this is weird coming from a lawyer. You're used to lawyers complicating things, but I'm also an entrepreneur. Start simple. I am going to be, and this was with my brand newbies. I don't know how many of those there are on the call that are actively getting involved. Probably not a lot of you. So not the perfect example, but it still illustrates a point. I'm a brand newbie. I'm going to flip and assign and own rentals and be a realtor. Oh, for the love of Pete, just do one LLC. You don't need one LLC for each one, but what if one of the businesses has an accident and it affects the other businesses? Listen, you're a brand newbie. 3 of these 4 businesses aren't going to happen the way you thought. You're probably going to discover a 5th business that never occurred to you. Why don't you let the facts play out? Let's see what makes money. LLCs can be undone. That bullet point is very important. I can undo an LLC most of the time, the vast majority of the time. In other words, no harm, no foul. Our default choice is an LLC. It's like medicine. I wish this rule applied to other things, like, say, politics. First, do no harm. First, do no harm. The LLC is the first do no harm entity. One LLC may be multiple businesses when they're micro, but as they start to grow and you can sense a pattern of what's going to stick, then maybe multiple LLCs for different businesses make sense. When do you do S corporations or LLCs taxed as S corporations? C corporations, LLCs taxed as C corporations. Those only apply to operating businesses, by which I mean the business is producing, you're selling services or you're selling inventory. You're selling services, or you're selling inventory. And it's not automatic. You just don't run, oh, John said I'm selling services. I'm going to automatically do an S Corp or C Corp. There's more nuance to it. Here's the problem with any type of corporation or LLC taxed as a corporation. Once you put assets in, this is really important. And I'm going fast because I must. This is really important though. Once you put assets into a corporation, you probably cannot get them out. Let me repeat that, super important. Once you put assets into a corporation, and especially investment property, take a look at the bottom, rentals, crypto, stock, debt that you own, not that is owed by you, gold, ownership, and private equity. Once you put any of that, those are classic investment assets, into a corporation, whether it's an S Corp or a C Corp, you're probably stuck with it. Sinuses. Once you put assets into a corporation, we're normally not able to remove it. It's rare because the tax cost is vast. If you have a rental property in an S Corp and you change the deed to an LLC, you have a taxable sale of the property. It is a deemed taxable sale with very real taxes. That's why you don't change the deed. For example, I have a property in an S Corp and a rental. I refi. The bank says it's cheaper to refi in my name. So I change the deed to my name, refi, get the cheaper rate, put it right back into the S Corp. If the IRS catches it, they will treat it as a taxable sale. They will come up with the fair market value of the property. They'll look at the basis, including depreciation you took. Whatever the difference is income. And you pay very real money on a phantom sale. So be very careful about putting property into corporations or removing property from corporations. What's the purpose of an S Corp? And again, there are a million points I could have picked. I just wanted to pick one and give you an explanation. One of the things you'll note that when I speak to you, I try hard to explain why. Telling you what is worthless because you have 15 other voices, maybe 7 imaginary in your head, the rest from the internet. I don't know. But you have all these other voices telling you other things. And if I don't explain why, then what I tell you is useless. It takes longer, I cover fewer topics, but knowing why is extremely important. The sole use case for an S corporation is to reduce self-employment tax. That is it. If you do not have a situation where A, you're generating self-employment tax, B, it's high, and C, the S Corp would actually reduce it, the S Corp is useless. So the sole use case for an S Corp or an LLC taxed as an S Corp is to reduce, not eliminate, reduce self-employment tax. And I put a brief example here. If you have 100 grand of self-employment taxable income, such as services or sale of inventory, you run it through a regular LLC or in your personal name, you're 100% taxable on the income for self-employment taxes. Now, if you're in the highest self-employment tax bracket, which a lot of you are, that's a 15% tax, so 15 grand. An S Corp, you run the same 100 of income, be an S Corp. I'm going to say 40 grand a salary. I'm making that number up. I'm not saying 40% is the right number. I am explicitly not saying that. I'm just making up this number. 40 grand a salary, which is subject to Social Security tax, which is like self-employment tax, but the other 60 grand is just a distribution from the S Corp. It is not subject to self-employment tax. Do the math, the self-employment tax is 6 grand instead of 15 grand. This is the classic use case right here for an S Corp, right here. If this is not the situation or something that comes to similar mathematical results, an S Corporation is a bad idea for you. It's that simple. It's easy to boil it down. It really is that simple. Now it's just applying numbers and so on. Last point here, you really want to have a salary study done every 3 years or so. Just like when you have a rental property and you get an appraisal done for property tax purposes to lower the property value and therefore lower the property tax. Usually with an S Corp, you want to lower the amount of salary, but you get a study done. They can be done pretty cheaply, typically $500 to $1,000 to get a salary study for an S Corp. Your normal goal, not always, there are different scenarios, right? I don't know you, but the normal goal is to make the salary as low as possible. Rollover business startup. Let's see how we are on time. Oh, I'm coming in. Actually, I'm talking like a New Yorker, but it's working. Rollover business startup, ROBS. This is definitely where the internet has both TMI and TLI. There's too much information. Most of it is, so rollover business startups are my favorite tax planning device for an operating business. For example, as a partner in a syndication. I mean, being a partner in a syndication is a service. You're finding deals, you're operating the deals. This is ideal for that. I'll tell you, I do it as a speaker. When I go up to the States to speak, I don't get my Puerto Rico tax break up in the US. Puerto Rico has no jurisdiction there. So I have one of these. When I show up in the US and speak, I use one of these. In fact, I'm going to go through the example. This is necessarily brief, and it is a very, very, very important slide that could totally change your financial life. In fact, the people who picked me up, the family office that bought me for the next 5 years or so for a nice sum, I use this to save them, let's just say 8 figures. So it really, and this, I did more for them. This is not all I did, but I love this so much. What is a rollover business startup? Well, I'm going to go through the second paragraph and return to the first one for the sake of brevity. Here's the final result. Without discussing the process, we lack time, but I want you to see the result. A Roth 401k owns 98% of a C Corp. You own 2%. Rewind, repeat. Roth 401k, which by the way, the internet doesn't tell you. Most of the ROBS material on the internet has what? A traditional 401k. And it's not self-directed. That's the problem with the internet, TLI, too little information. TMI, I guess there's so much other information. The franchise world people who only know traditional and only know Merrill Lynch and don't understand private equity. It doesn't occur to them. There's too much of that information, which is really inferior information out there, and it blocks out the good information. You need a guide. You need someone who can sort it. The internet is not the answer to all things. So we have a self-directed Roth 401k, meaning self-directed. What can you invest in? I don't know, maybe syndications. Oh, how cool. Does anyone do that? Owns 98% of the C Corp. You own 2%. The C Corp pays 21% tax on its net income. Stop right there. For me, that's an advantage, right? In the States, when I appear in the States, I make enough. Because when I speak on a stage in the US and sell on a stage in the US, that's US income, at least some of it is. If I make enough, I'm past the 21% bracket. So first thing is bracket arbitrage. I'm paying 21%. That, by the way, is the side benefit. It's not the main benefit. Usually you distribute the remainder. We're going to go through an example. 98.2, making your Roth 401k massive. What is happening here? I am allowed, there are prohibited transaction exemptions. I am allowed through this ROBS, this rollover business startup, to provide services. Let me take a drink and I'll explain through an example. It's a better way to learn it, especially given the speed I'm going. I go to the US, I speak. Let's say I generate, let's just make it round easy numbers, $1 million. Do we all agree in the States, I would be taxed at 37% roughly on that kind of money, mostly. I mean, you could talk about blended rates and all that, but I'd be in the 37% bracket for sure. Is 21% a good deal? Yeah. Is that the reason I'm doing this? Not really. That's just a side benefit. It's a hell of a side benefit, 41% difference, 16 points. The real reason I'm doing this, so I make $1 million, and the sole employee, it doesn't have to be this way, but this is the best use case. I'm the sole employee. I go talkie. People pay me $1 million. Let's just round. There's 800,000 left after paying taxes. What do I do with the 800,000? 98% goes into what? My Roth 401k. It goes into my Roth 401k. Is the dividend from the C Corp to the Roth 401k taxable? No, because the Roth is exempt. So if you get my dividend, the 2% to me does get taxed again. But the 98% that goes up into the Roth 401k, let's see, I put up 800,000, so multiply that by 0.98, whatever that is, some numbers, like let's just say 790 for ease. 790 grand got taxed at only 21% and ends up in my Roth 401k where I can invest it tax-free for the rest of my life, plus at least 10 years. That's the beauty of it. The primary benefit is, what are you doing to the Roth 401k? You are converting your services income or sales income. If you sell a bunch of stuff, for example, if you're into flipping or assigning houses, this works. You are converting services or sales income that is probably being taxed at a comparatively favorable rate into a massive Roth 401k balance. Is this great? Of course it is. Is there any case law? No. How much has been written on this by the IRS? Paragraphs, nothing more. Paragraphs. The landmines, I don't have time to go into them, the landmines they lay out are all very simple to avoid. The most complicated part of this, by the way, it's been around for at least 15 years. The IRS just released a white paper in 2023 that was almost identical to the white paper they put out in 2008. What does that mean? They haven't been going after it. That's why there's no case law. That's why their white paper is this big. And they very kindly give you a bullet pointed list of, don't do this. It's about 6 items that they say, for example, here's a hard one. If you have a C corporation, 98% owned by your Roth and 2% owned by you, we think it should file a tax return. Check. That's an easy one. Most of those bullet points are pretty easy. So right now, the IRS is not hot to trot for these, nor is Senator Wyden, the very anti-Roth IRA guy, communist Oregon, and neither is ProPublica, right? Those are, by the way, if Senator Wyden and ProPublica don't like it, I'm super interested, right? What they do is they put out what they consider inappropriate tax planning techniques used by bad people known as the rich to not pay as much as those people would like. And then they put out a legal suggestion or a legislative suggestion of here's a law to stop this. If that law doesn't get passed, and it normally doesn't, what do we have? Roadmap. This is not even on their radar. I saw one article on ProPublica where they're like, yeah, we kind of heard of it. We think it's just a franchise thing. We're not real concerned. You know when they'll be concerned? When somebody leaks the information over at the IRS. The nonpartisan IRS leaks the information, and ProPublica and Ron Wyden figure out what people are doing with these accounts. Then you'll start to see a movement to restrict it. Get while the getting's good. Most of this stuff gets grandfathered. So my personal example is $1 million, pay the 21% tax, round it to 200,000. Most of that goes into my Roth 401k. Most of that is self-directed and does not incur tax until at earliest 10 years after I die. This is ridiculous. Do get on the internet, do research it. But remember, most of the internet on this is geared towards franchises. It's geared towards conventional investing, and it's geared towards traditional accounts. And also, there's almost no discussion, even if you look hard, there's almost no discussion on prohibited transaction exemptions. In other words, things that would normally not be allowed in an IRA, like providing services or taking a salary, some of those things, not all of them, but some of them are allowed in a ROBS. That's very important, very nuanced, and very hard to come by information. Very briefly.
Can I ask, because a lot of people were asking that 98 and 2, is that you can make that whatever you want, or is it always 98 and 2%?
You always want, you don't want the retirement accounts to own 100%, or even just for safety's sake, I like to see 2% non-retirement account ownership. But can you vary it? Can it be 5 other people are involved, or 5 other people's 401ks, and then a 2% human? Yeah, but I always want to see 2% human. And there are legal reasons for that.
10% human?
Oh yeah, more human is fine.
Okay.
Less human is bad.
Got it. Thanks.
So let me go through this briefly, and then we'll do Q&A. Guys, I no longer am available to hire. I don't do a lot of Q&A, which we're about to do. The only ways to get me are when I do private events. There is one coming up. I'll be brief. I don't oversell. If you're interested and think I know what I'm talking about, great. If not, great. I don't have feelings to hurt. I have sufficient ego to spare. If you require any, I have plenty on demand. Bottom line is it's going to be 8 Zoom courses, 2 hours each. 8 Zoom courses, 2 hours each. We are going to go into horrifying detail. In fact, I think I called the course, if you go to the website, John's Horrifyingly Detailed Entities Course. Choice of entity, how many entities, where to set them up. This is really important. This is where you guys really fall down. How to maintain them properly. By the way, you won't like it, but you do need to know it. It's more work than you would like, but it is an accurate and honest appraisal. At the end of each session, for the first 6 sessions, there will be Q&A. I will take questions ahead of time to consider. The last 2 sessions of the 8 will be pure Q&A. That's one of the few ways to get a hold of me now for discussion and Q&A. Look in the comments box. There are plenty of people who've been to my seminars. They'll tell you what they think. I don't fear the answers one little bit. Bottom line is I will add a ton of value. There will be no upsell. 0 upsell. It's pure content. Guys, I don't have anything else to sell you. Like, I can't upsell even if I wanted to. And those of you who've watched me try and upsell can attest to the fact I'm really not very good at it. So bottom line, we'll give you a link on the next page. If you're interested, great. And if not, that's cool. Hopefully you get something out of this on its own. So there's the website, there's the cost. And as I always tell the real estate investors, don't call me to negotiate. I get constant emails from real estate investors. It's like, I'm not divorced. I didn't lose my job. I'm not in foreclosure. I'm not motivated. Stop, just stop. But I look forward to being able to slow down, speak at Midwestern speed instead of New York speed, address your questions in detail, and provide a lot more detail. And this will be fun. Sarah, let Chris talk briefly if he wants to. Chris is a frequent offender.
Okay.
Let's see
I'll
what
say,
happens.
guys, the link is in the chat if you just want to click. Cynthia posted it so you can sign up.
Cool.
Let Chris speak. All right, Chris. I have my finger on the mute button just in case. Just in case.
He's usually pretty good with tech. There he is.
All right. Go for it, Chris.
Can you guys?
I can hear you. Yeah.
There, we're good?
Yeah.
Yep.
Awesome. Thanks both of you for putting this on. Really do appreciate it. Quick question, John, just, with estate taxes going up, at 20 or potentially going down in 2025, let's say it goes down to 10 million. And this, I promise you, this pertains to IRAs or 401ks. And you have a balance, let's say the limit is 10 million. You got a traditional IRA or 401k, and this passes on to your kids and they got to pay ordinary income over 10 years. If it's above 10 million, do they also have to pay 40% on top of whatever ordinary income they'd have to pay?
Retirement accounts are part of the estate, meaning to the extent estate taxes apply, the IRA or 401k balances are subject to that.
Wow. So
Yeah.
if you're in California and you're paying 50%, tax on let's say $1 million over, and then you have another 40% on top of that. I mean,
And that's where you get
Nothing
into,
left.
that's where you get into something I'm not good at. I have a clue, but I'm not good at it, which is the estate planning. In other words, you can't really gift an IRA or 401k while you're alive, meaning you can't avoid the estate tax via the classic means of getting it out of your estate by gifting it. Now, there are probably some games the really sophisticated estate planners play to reduce the values of those or some such. Not really what I do well. I was expecting something spicier from you. Chris and I have a history, and it's usually a very spicy question.
I was waiting for it.
I will say I converted my 401k over to a Roth. Look, if you guys worked at a long employer, a W-2 for a long time, and you've got a decent sized 401k, this is a great opportunity to convert that over to a solo K, and then do a conversion over to Roth at a discount. I wish I had done that. I had a 300k 401k that I converted from traditional Roth and paying 6 figures to the IRS. And this was in 2010, well before I knew John, well before I knew about converting at a discount. And had I known that, the account would just be that much higher, and I'd have paid a lot less. So wish I had that knowledge beforehand.
Cool. We'll move along then. Always nice to see you. And to his eternal credit, since there's so much to his eternal discredit, Chris is an admitted and open bourbon mule. Just saying.
I just think it's so funny, John, that you make fun of me for living in California, and yet now you live and are surrounded by, Puerto Ricans and are much more democratic than I am over here.
Yeah, they are to the left of California, but they exempt me.
All right. Thank you, Chris. Nice to meet you.
That was a softball by Weiler standards, by the way. I was hoping for maybe he'll come up with one for the next call.
Yeah.
He's really spicy.
Yeah, that was very benign, very benign. We can move over to Q&A. I see you guys have a lot going on in the chat. I've been answering what I could. There are some questions. Well, there's a ton of questions we won't get to today. So this course is a great chance for you to actually ask John your questions directly. We'll get to some now, but not to all of them. And so if you have a really particular scenario, I see a lot of really specific scenarios, not like, generally, can you do this or that? If you have a particular scenario, you need John's advice on your use case. $1,500, that's hardly anything. You're gonna save a lot. I'm surprised the price was so low, actually, John.
I'm going for volume.
Yeah,
Because
it's awesome.
It's really no extra work for me. I've already gotten enough that even at my new hourly rate, to the extent it would apply, I'm well past.
Yes, amazing, awesome.
So I enjoy the questions, because I'll tell you what, one of the things Weiler in particular really stood out for is asking questions that I actually had to go think about. That's why I like it when people send them in ahead of time, especially him and a few others. He has a coterie of similar people who they come up with stuff that you're like, what kind of diseased mind?
Complex.
Oh yeah, creative. Some really creative stuff. So I would say let's pick some of the general ones here.
Yes.
Oh, let's see. They're just coming up so quickly. Do I just pick randomly, or do you guys want to pick one? Let's go to the Q&A box. Let's see what it says.
Yeah, let's do that.
I was under the impression there are income limits to contribute to Roth. If it's an IRA, you can get around it with what's called a backdoor Roth IRA. And then with 401ks, there is no income limit for Roth. That's a very common question.
Is that something you would be talking about in your course, or not really, since it's more entity focused?
Yeah, I wouldn't talk about that on an entities course, but that's such an easy question. I mean, that is the answer. It's just a very simple answer. So that was actually an easy question.
Perfect. I saw a lot of questions around, but how can we actually go do this? So 2 answers. If you're looking for someone who will do discounting, John has some recommendations and I have some recommendations. And so the replay email, this was all recorded. You can see the recording. You can share it with whoever you want. The replay email will come from Sarah at SuGo Capital. and it will have a list of folks you can contact to do the assessment for you for your investment. It'll have this recording. It'll have a link because you actually need the investments to make the strategy work, right? So it'll have a link to our investments that can make it work. So all of those resources are coming because there are like 200 questions around that.
Okay, and I'm just scrolling through questions, like the ones that are super niche. Like if I live in Puerto Rico under Act 60, let's talk conversion. Well, you're the only guy on the call who cares. So it's a really cool question, but not applicable. So I'm just scrolling through to see what would help the most people in the shortest time. Can you convert from solo K traditional to Roth IRA or 401k Roth? You can do either. You do want to convert 401ks as a self-directed vehicle are superior to IRAs, vastly superior. I won't go into the reasons. That's a separate course that maybe I'll offer later in the year. Maybe I won't. I just don't know. Because I do a self-directed IRA one as well that is generic. It includes 401ks. But there are a list of about half a dozen strong reasons that 401ks, self-directed 401ks, are superior to self-directed IRAs. So whenever possible, you want to convert to self-directed 401k. For example, it's a one-way process. Could I convert a Roth 401k? Whether it's solo or not doesn't matter, right? A solo K is just a really cheap 401k Roth. It's just a cheap version of a 401k. That's it. It's just cheaper, which is nice. We all like cheap. You can convert a Roth 401k to a Roth IRA. And it would be very rare for you to actually want to do so. There are one or two very odd use cases where I have seen it work. But bear in mind that once you convert to a Roth IRA, you are stuck in a Roth IRA. Roth IRAs do not convert to anything other than other Roth IRAs. So that's actually the reason I took the question is I hear it a lot and it's a useful one. If you're going to convert to Roth, ideally you do it to 401k. What if I can't have a 401k? Create a micro business. Go out and sell $2,000 net profit, not round. I hate round numbers on tax returns. So $2,356.79 of stuff on eBay or whatever it is you do to generate legitimate, honest, actual income. It's a separate trader business. You're selling stuff so you can contribute. You can have a solo K with this tiny business. Move your traditional IRA or move your accounts from your old job. You have a you have a 401k, whether it's traditional or Roth from your old job. Create a micro business. Roll the old 401ks. Roll the traditional IRAs into the solo K from your teeny tiny business. Your teeny tiny business is so small, it doesn't even need an entity. It just needs a separate bank account. Now you have all the benefits of a 401k. That's a huge one. In California in particular, when you go from one job to another, do not miss the opportunity. So many of you automatically roll your old job 401k to the new job 401k, and it keeps you from doing alternative investing. You're stuck with inferior Wall Street stuff. I don't personally invest in Wall Street at all. I want more knowledge and control. And so personally, it pains me to see people move from one job to another and take the 401k to the new job. Just painful. Let's see what else is in there. Let's see. And Sarah, if you spot one that you particularly like, let me know.
Okay. I will call it out. I think a lot of them are quite repeat of the same thing. A lot of other people asking, so does discounting work with a solo K?
Oh, yeah. Yeah, a solo K is just a simplified 401k, meaning it's a lot cheaper, but the same rules apply minus a lot of the costs. Will this work for hard money debt funds? Yes. Now, some funds, as I pointed out, depends on the nature of the fund. I'm in one that's very liquid. And so my discount was much smaller. Depends on the terms of the fund. Does this work for closed-end funds like in stocks? Not necessarily, because the stocks are all publicly traded and they have a value. So I can't discount. There is a discernible daily posted value. There's liquidity. Those stocks can be sold. Now, is there a discount for a closed-end fund? Because the fund itself may not be liquid, but the underlying assets are liquid. I'm thinking. I haven't thought about that one. I would have to see the terms of the agreement. Here's my guess. My educated guess is a closed-end fund that trades publicly traded stuff internally will get a discount, but not as large as private equity. That's my gut feel.
All right, I got two that I see that I get all the time. So if they have an IRA and they do this for like a few investments, they roll over, then at the end of the year, do they do one 1099-R form for that account, or they do it for each investment they discounted?
One 1099-R for the whole account.
Excellent. And then the other question that I get a lot, where was it? Oh, will it trigger anything scary or make it not work if then I get a K1 and my K1 says my investment's worth 100,000 and I just converted it, I just rolled it over and said it was worth 50,000. Will that matter?
No, they're not that coordinated. In other words, you're giving Skynet way more more credit than it deserves for matching things. But let's say they were to pick it up. You have an appraisal, right? The valuation was on X date. My appraisal was on X minus whatever date. And so unless I would tell the IRS in an audit, look, unless you can, I have an existing, and this is important, contemporaneous appraisal. It was made in real time. You're looking at this after the fact and disagreeing with the value. You are more than welcome to do that. I need you to go get an appraisal because this is going to tax court. Have a nice day. Very rare that they'll do that.
I saw a couple of questions in both locations around ROBs. They said, how can we apply this if we primarily have passive income? Can we still somehow use that structure?
ROBs probably doesn't make a ton of sense if you have passive income because it's by nature to house an active business, which is good. It tells me that you understood the gist of the ROBs in spite of the rapid, brief explanation. It is meant to be an active thing. And I'm using the term generically because different people use different words in different ways. For example, the word passive is probably used 30 different ways in the code, but mostly passive income would be done directly in the 401k itself. Mostly. Now, some passive income can generate what's called UBIT, unrelated business income tax, based on the underlying nature of the business you're investing in. And this goes back to if the business sells stuff or provides services, you still may want it in a ROBS or in what's called a blocker, a C Corp owned by a 401k or IRA. And the reason is inside the IRA or 401k, it creates a tax called UBIT that I speak on extensively. And it's a very high tax. In California, you're looking at 50%.
All right, next question. I'm going to choose David Coffees. He said, will this work if I just move money from my non-self-directed IRA traditional custodian to a self-directed IRA custodian and use this whole strategy without putting in new money? And yes, that is a very
big so let's talk about that briefly. You have a traditional one, it invests in the market and such. You move it to self-directed, so now you can actually invest in private equity. Will it work the same way once you move it to self-directed? Yeah.
Awesome. Paresh is asking, does this have to be done via an LLC or can the IRA directly invest in the syndication and then do the discount conversion?
It can be done either way. I prefer it done directly by the IRA. It's simpler. There are problems with checkbook LLCs that I won't get into. If you look up, there's some of it online, but mostly, again, it's a separate class. There was a case called McNulty, and it greatly made checkbook LLCs owned by IRAs, not 401ks. Big distinction here. Checkbook LLCs, in other words, an LLC 100% owned by an IRA, much more dangerous for the user than an LLC owned by a 401k. So it's just another reason that I prefer 401ks.
Thanks for that. Trying to answer and read analyst at
Oh, it's hard. No, I'm skimming and there's some great questions. The problem is
one if you see one too.
We're mortal, and in this case, very mortal.
Oh, I saw a few about inherited IRA. Can someone do a conversion with an inherited IRA?
No, inherited IRAs, once their character is established, it is permanent, with one exception. If you inherit a traditional 401k, the traditional 401k that you inherit will become an inherited IRA. You may choose if it's a traditional inherited IRA or Roth inherited IRA. You would pay the conversion like you normally would. That is a very, very, very important choice. Inherited traditional IRAs, even if it came through a 401k, are fairly useless. Inherited Roth IRAs are very good. So if you inherit a traditional IRA, you're stuck with it. If you inherit a traditional 401k and you move quickly, before they convert it to an inherited IRA, whether traditional or Roth, you actually are able to convert.
Okay, awesome. There are a lot of people asking that. That's good to know. I see a few folks saying, can I have a specific session with an example showing discount strategy steps on SuGo Zocalo project? So yes, I'll include that in the email because it's not any different than the steps that John laid out. But I'll actually, in our replay email, I'll type out the steps for you with links of exactly what you need to do.
And you're going to add the one step that I missed, which is talk to you guys about title changes.
Yeah, so we're good with that. Then you need to talk to your custodian and then go through the steps. And we'll provide a link to the property that you can use with this strategy. We'll have some discounters if you want to do it yourself, but also for this property, I will have someone who will do the analysis for everyone, and then, you know, everyone will pay. So if you want to participate in that, I'll have it set up for you. And the timing is, John said, to do it right after closing. So some people were asking, what is the timing? So if we take over the property November 15th, then right after that, we'll engage the analysis.
Cool. And you can keep going. I'm just going to say hi to all the familiar. They know who they are. The familiar.
Yeah.
I'm seeing a lot of familiar names here, and hello to the new people too. I mean, it's just I'm sort of gratified to see the people who know the nature of my issues and showed up in spite of that.
In spite of it. Even some new people were sending me messages like, where did you find this guy?
Yeah.
I found, I don't remember how we got introduced, but we were introduced several years ago. And every time John comes and speaks to our investors are like, thank you, Sarah, that was gold. So, so we keep having John back. Yeah. John, do you want to, we're at about half an hour over. Do you want to stop here? Do you want to keep going?
There are so many familiar faces. As long as you're good with it, let's go a little bit longer. I mean,
okay.
the only
Yeah.
thing is I reserve the right to refill the glass.
Yeah.
Because we're actually at my hour. My people, my regulars know that I started an hour early. I normally drink 2 ounces at 4 p.m. I've actually, in my anal tax lawyer way, measured on this with lots of sample sizes, how much it interferes with REM sleep and deep sleep. And I've determined that 2 ounces at 4 p.m. or earlier is not a problem.
Well, actually, in Eastern medicine, they say that's the perfect time to drink is around 3-4 p.m.
And they figured it out without the freaking.
Yeah.
They knew it long before this.
Yeah. So between, like 1 o'clock is not a good time, you know, past 8 p.m. is a bad time, and said ideally 3 to 4. I'm like, all right, well, I'm kind of running kids around to pick up from school, so it's not a good time for me to drink, but for weekends, I could comply with that.
Oh, now you can tell which ones are used to me. Like Robin, I wondered why you were drinking early. It must be the sinuses. See, she knows me.
Awesome. Well, feel free to pick whatever questions you want, John. I think most of the ones that are left have to do with
All right,
your area of expertise.
Let me go to the Q&A and just see what pops up rather randomly.
I see someone asking about Park at Ashford. So that's something we closed a few months ago. So if there's enough people in here who were in our Park at Ashford investment and you guys want to do this, let me know. It's only a couple of months. So like John said, that won't really affect the numbers that much, but I'll organize a group effort as well for that one if you guys want.
Cool. So let's see, Mike's asking, I'm the trustee of my solo 401k. Wouldn't it be a conflicted party for the paperwork? No, you're actually required as the trustee of your own 401k. And this is one of the big differences between a 401k and an IRA is the IRA requires a separate custodian. With the 401k, you're the custodian, AKA the trustee. So there are certain duties you have to perform. And to help protect you, because some people think, well, wait a minute, I'm performing a service for my account. If they've been around me long enough, this is appropriate. If they've been around me long enough, they know that providing a service to the plan is a prohibited transaction, but we don't know what a service is. So is doing accounting work for the plan a service? It's not. There's actually a prohibited transaction exemption. It's code section 4975 D2. And it says you can do accounting or legal work for your account. And as long as you don't pay more than fair market value, you're good, which means you can actually pay zero because it doesn't prohibit you from paying less than fair market value, which by the way, I would pay zero. Paying yourself money from your account to do things, even if someone told you it's sort of permissible, with the exception of a Rob's, is a very bad idea. Okay, just going through here. If you create a C Corp for a Rob's, if you utilize traditional 401k funds to purchase the Rob's C Corp, can you then convert to a Roth at a discount? All right, so the way a rollover business startup works is you have a 401k, it's buying the C Corp, 98% of it. What he's asking is, if I buy with traditional money, can I get a discount when I convert to Roth? Because I'd mentioned that there is a discount for C corporations. And the answer is yes, but you would have to have more than 50 grand. And for some background, I tell people it's not a requirement. Like the guy I recommend for Rob's, and if you want that referral, email me. It's on the first slide. The guy that I recommend for Rob's, you can put 3,000 into the rollover business startup and he'll set it up. I don't think that's illegal. I think it's bad optics, right? When the IRS finally looks at this, what's one of the rules when dealing with bureaucrats? They look for funny things that look weird to them. I think the number 50 grand for a startup, even if it becomes huge, is a realistic number. I think 3 grand looks funny. Now, if you only have 3 grand and it's create it or don't, well, then just do it with 3 grand. Here's my issue. Why is that relevant to this question? To do a conversion on 50 grand, because the C Corp discount's usually pretty low, probably, I don't know, 15 to 20%. So to get a discount of 15 to 20% on 50 grand, is it worth paying an appraiser? I don't know. You'd have to figure that one out. So can you theoretically get a discount in a Rob's for starting with traditional, converting to Roth? Yes. Is it worth it? I think the size matters, both of the discount and the amount that you're investing. And again, interrupt at will. You know your group better than I do, so you're going to know which questions are the most germane. In fact, I will take a quick bit of water.
Other kinds of things. So we covered, is this just for IRA, Roth conversions? You said, no, it can work for 401k conversions. Does it work for SEP IRA, defined cash benefit plans?
Defined benefit plans, I've never seen a Roth defined benefit plan. You would have to end the plan, roll it to a 401k, typically at traditional, and then you convert it. But to my knowledge, Roth defined benefit plans don't exist. So you would have to roll it to a different kind of plan.
Cool.
Let's see. I'm just scanning because, again, I want something applicable that doesn't take me 20 minutes to answer.
Yeah, what about this one? You talked about micro business for setting up a solo K. Is there any minimum requirement, like minimum number of hours to work or minimum income or something like that?
Here's what I want to see, and this is just my gut feel.
Yeah.
I want to see a number greater than $2,000 per year net profit. Net profit after all expenses. I want to see 2 grand a year. Can I support that? I mean, theoretically, you don't need to show any profit. I think that's a very bad narrative. Would I like more than 2 grand net profit? Yeah. Would I like exactly 2 grand net profit on the nose? No, I hate round numbers on returns. They attract attention. As long as it's legit, like not fake stuff, right? My cousin paid me to consult on what? Which bourbon to pick. Yeah, that's kind of sketch. Like bourbon, but no. On the other hand, I sold stuff on eBay. I'm really into when I was teaching my kids how to buy and sell stuff, among other things, we would go to estate auctions and buy really old games. For the old nerds on the show, Avalon Hill, Dungeons and Dragons, models that you put together with model glue, some of the wooden balsa planes that went back to the 50s, old kitsch, just for fun. And we were able to easily generate over 2 grand with that. And it was father and son time, and because my daughters, we bought things they found more interesting. And so, something along those lines, but it could be anything. I mean, it could be consulting fees, but legit. You actually performed a service, you charged a fair market value to a third party, not this cutesy, lazy crap. I'll give you an example of cutesy, lazy crap. I want to pay my kids a salary, and so they model. Your kids are ugly. They're not worth what you're paying them.
Oh no, my kids are really cute.
I mean, not your kids, just generically. The human race. I'm sure that the people on the call are superior genetic samples that do the race proud and should be carried forward via the Darwinian fashion. But everybody else has ugly kids. Bottom line is this, it's lazy. Your kid's time is not worth, I took a snapshot and paid him 15 grand. Unless I have had a few clients who actually are like, no, we live in Beverly Hills and a legit modeling agency actually pays our kids that much. And so we pay our kids that much. Fair, totally fair.
Fair. Yeah.
So yeah, just don't get cutesy. Because remember, you're protecting a massive thing. Let's say you move 2 million from work 401ks and traditional IRAs into a solo K. Do you really want to play games with the genesis of that solo K? You do not.
Not worth it at all. Yeah. All right, Lori, you have a good one. I'll take a crack at this. So I have a self-directed IRA in a checkbook LLC with 4 accounts in it, 2 IRAs and 2 Roths. They have different percent ownerships.
Oh, okay. I see what's happening. Go on. Or is that
Can I
it?
use this to invest in SuGo properties? For me, the answer is yes. And can the discounting work? Because there's a lot of layers to this is what I'm adding in as a piece of work question.
Yeah, there's some nuance here. I always have to explain why. So there's nuance. First of all, this is very frequent. What happens? Related accounts, 401ks, IRAs, HSAs are small. They all invest into one LLC that they own, 5%, 20%, 32%, whatever. They own them jointly. That LLC then invests in stuff. So here's the division. I'm going to tell you the law and I'm going to tell you what's actually happened because those are 2 different things. The law is that they're jointly investing in fungible things. If they could have invested in SuGo on their own anyway, on their own with no help, you're fine. In fact, there's a Department of Labor ruling that allowed exactly that to invest with, Bernie Madoff was actually allowed to invest with Bernie Madoff. So the tax advice was great, investment wise.
Yeah.
Now, if these accounts are related persons, and they usually are, spouses, kids, etc., it would be a prohibited transaction to have them all invest together in something that one of them could not invest in alone. So you go buy a house, they each have 10 grand in it. There's 5 members. The house is 50 grand. None of them could have done it alone. They were able to do it together. That would be a prohibited transaction. It would be penalized at the 401k level. It would cause destruction of the account for IRAs, HSAs, CISAs. Now, I will say this, so that's the law. And there's no case law. It's just that I know that's what would happen in court. The IRS has not gone after those. They only go after it if you use your IRA to help you invest in something personally. They're really sensitive about that. So they haven't gone after these family LLCs that have a bunch of IRAs and HSAs as members, but they could. So you have to decide with a non-fungible asset or where there's a minimum. Let's say there's a minimum, 50 grand to get in, and one of those accounts doesn't have 50 grand. I wouldn't do it.
Oh, okay.
Now, if it's a 401k, I will say this, the penalties are much lower. So again, another thing I like about the 401k, prohibited transactions are much smaller penalties generally than in an IRA. But I wouldn't lose sleep over it. Let's say you've done this. Should you now be paranoid at 2 a.m? No, you got better things to think about at 2 a.m, like the mean stuff you said to some chick 30 years ago. That's a much more valid thing to think about at 2 a.m. Oh, wait, that was me. I've gotten way better. Reading all the books on the Stoic thing and all, I've gotten way better. But would I stay awake at night if I did this? No, because the IRS hasn't gone after it and they've shown no inclination to do it. But going forward, you have to ask yourself, do I want to take the risk? Right? So I can only advise you, and this isn't really advice, it's education, but my lawyer training kicks in. I have to tell you what I think is legal. Now, if you want to work the odds in, well, I don't think they're ever going to go after that. That's a you decision. That's not a me decision.
So if it was, so if it's I want to understand because I feel like now people are going to ask me this question, so I want to be prepared in the future. So if they have the structure where there are like 2 traditional and 2 Roths under the umbrella, and they use the top level entity to invest in an investment, and they try to do discounting, that won't quite work. They need to use the like sub.
So they can
entity.
do the discounting. The discounting is not a problem. It's complicated just because of the nature of the structure, but you can do the discounting.
Okay.
Thing to watch for, probably the simplest analogy is husband and wife. But remember, my IRA and my wife's IRA are disqualified as to each other.
Right.
Et cetera, et cetera. My kids, et cetera. If any one of those accounts needed the help of the other accounts to get in the deal, whether it was a minimum investment amount or it was a non-fungible property that they could not have invested in on its own. That's the real key. Could it have done the investment on its own?
Yeah.
If the answer is no, it could not have. It needed these other prohibited person accounts, technically disqualified person accounts, to invest. The IRS has a hell of an argument, I think a winning argument, frankly, that that is a prohibited transaction. Now, they haven't gone after it, and they've shown no sign of going after it. So I've told you the law. You must now gauge, as investors and business people, the risks.
There you go. All right, somebody's asking, is it better to use a Roth IRA or a solo K to invest in real estate? I'll say from my point of view, you bet you don't have UBIT in 401k. So I always give John's example when someone says, but I don't have a solo K, how do I do it? I say, quick, do a micro business, get it started, roll your IRA into that solo K. And I said, we can hold your spot. Just get it going. It doesn't need to be open for a certain amount of time before you can use it to make an investment. So you can open it with your micro business, you can roll into it, and then you can invest with us using that 401k instead of that IRA.
See, this is awesome because we now have video recorded forever permanent proof that some women do listen to me, and I can show this to my wife.
Yeah, definitely. Andy, great question. So Andy's saying, well, I'm an accredited investor in all these things with SuGo Capital. You need to be an accredited investor to invest. So how do I know if my IRA is an accredited IRA?
If you're accredited, it's accredited.
Yeah. So an LLC needs to be accredited as an LLC, but your retirement accounts, if you're accredited, then your retirement accounts are accredited.
And if you have non-accredited people in a multi-member LLC, that's a problem.
Yep. Then it's not accredited. So an LLC is only accredited if all the members are accredited.
Correct.
Yep. All right. I don't know. There's 34 new since I last looked, so.
I may need to present sometime in my copious spare time because this new outfit I'm with gives me a little bit of leeway to do my own stuff.
Oh, great. Yeah, let's keep it going.
I may do a full-blown, kind of like the entities course. I might do a full-blown IRA 401k course because we're getting all the classic questions. I mean, I wish I could answer them all. I mean, I could, I'm just not going to.
But, I mean, it's about, well, there's 68 plus 35 that I see. So
I'll go for another 15 minutes if you're game.
If you'd like.
Okay. I would say pick out what you know, your people, because you know your people.
Yeah, I think we answered most of what I think are generally like the biggest questions that we get as an investment firm from our investment community.
Okay, so we can look at some of the weird stuff the reprobates are putting up.
Yeah. Oh, wait, I saw two different things now. Can you roll a Roth IRA to a solo 401k Roth? I saw someone ask and someone answered yes and someone answered no. Oh, no. Sue, he's shaking his head. Sue, you won. You got the right answer. You cannot.
Yeah, Roth IRAs don't roll.
Yep. So a trad IRA can roll to a Roth solo K.
Yeah, the first thing I would do if I have any traditional IRAs is, if need be, create a micro business, create the solo, roll all the pre-tax traditional up to the solo. If you happen to have any traditional after tax, most of you don't, some of you might, I would roll that to Roth and not pay any tax on it.
Yeah.
And just get rid of the traditional IRA and have that traditional / Roth solo K. It's just superior.
Yeah, I see a lot of people saying, wait, so how do I do the solo K? How do I avoid the U-bit? John just said. So he answered all those questions with that one statement. That was perfect.
Okay, somebody wants to lend money from their traditional portion. This is Norm. He basically wants to lend money from his traditional to his Roth. No. I mean, it's a great idea. Somebody did it with preferred dividends, slightly different context. You are not allowed to use one account to benefit a prohibited person. Again, I should be more precise, a disqualified person. So one of the biggest prohibited transaction, in fact, the biggest prohibited transaction issue, because it's so gray and nuanced, you cannot use an account to benefit a disqualified person. There used to be an outfit out there telling people, have a preferred stock arrangement. So you're going to buy into something for, I don't know, let's say 100 grand. And your traditional IRA is going to put in 95% of the money and make a 6% return. And your Roth IRA is going to put in 5 grand and make the common return, meaning it gets all the upside. Well, you are using your traditional IRA to benefit, to pump, to fill your Roth IRA. IRS would win that one easily, hands down. So it's creative thinking, and there are other legitimate ways to do it with other people, but not with, I would not do that with disqualified people.
Awesome. Oh, this is really interesting. So we have folks who invest in oil funds through SuGo Capital.
All right, can you pronounce it like a Texan? That's the true test.
Pronounce oil as a true
Yeah.
Texan?
Yeah.
No, let me hear you do it.
I can't do it. It sounds all weird. All?
Oh.
All? I know.
Yeah,
I mean,
you're right. You're right.
there's a Texas way to say it, and that's how they know.
Oh, no, I just say the
Like if
California.
Texas ever goes to war with the rest of the US, a distinct possibility, the passwords would always be all, because no one else can pronounce it, and therefore they would be able to identify all the
They would
infiltrators.
type AWL, so since you invest to get your tax benefit, you're a GP for year one. Someone is asking, does that count as a micro business? Can you open a solo K based on your oil and gas investment? I think the answer is no.
Repeat that again?
So someone invests in an oil investment and they're listed as a GP, so they get the tax advantage for the year one.
No, because you have to have you actually have to do so for the income from a business to fund a retirement account. It has to be what's known as compensation.
Okay.
Compensation means you're paying self-employment tax and your time is involved significantly in generating that income, and your time is involved. And that's the part we're missing. Or you're getting a W-2, which might be paid by the company itself.
Thanks for that. Okay. Greg, once funds are converted from trad to Roth, solo K, and doing discounting and all that, is there any restriction on tax-free withdrawal of Roth principal from the solo K?
Let's repeat that. Sorry, I was reading one.
So once they use this whole strategy, discounting, and now they have a Roth solo K with the money in it using discounted asset method, are there any restrictions when they withdraw the principal from that solo K, from that Roth solo K?
Nope. It is full-fledged 100% Roth money.
Okay. So Liliana is confirming the steps. So I create a micro business, specifically product-based. Well, John said it could be service-based as long as you're actually doing some consulting work at fair market value. Then create a solo K, then transfer my old Roths into it. Question mark. Did I get that right? She says.
Run that by me again.
Create a micro business, then create a solo K for that micro business, and then transfer my old Roths or your old 401k.
Well, let's be clear. You can transfer Roth 401k. You can transfer all traditional and Roth 401k into that, but you cannot transfer Roth IRA into a 401k.
Yes. So you can't transfer your old Roth.
If it's a Roth 401k, you could. Although most corporate 401ks are not Roth. Most are
Right.
not. Some are, but not.
Yeah.
So if you're asking if you can transfer a Roth IRA into the micro business, the answer is no.
She says, got it. All right, good. Okay, I think I skimmed everything in the Q&A, and there were a lot of repeats, so I think we hit them at some point. Yep.
Oh yeah, they're going nuts in the conversation. I can't even follow it.
Yeah, there's too many. There's too many. What I would say is what we're going to do for you guys is we're going to send out this recording. So an email is going to come from me, Sarah@SuGoCapital.com. If you reply to it, it goes to my team. It goes to hello@SuGoCapital.com. So if you need anything else, just hit reply. But what we're going to do is we're going to send the replay. It'll be a recording of this, the whole entire thing. You can watch it again if you came late or if you left early. And congratulations, John. We're almost an hour over and we still have half the people here.
Yeah, just
Yeah,
kidding.
entertaining. So you can share it with whoever you want. This is not private information. You didn't pay for it. So don't, feel like you can share it with anyone. We're going to share the steps you need to take for your conversion. We're going to share, John, do you want to share any of your slides or not?
Yeah, you can share the slides. That's fine.
We'll share the slides. We'll share, some people said, how do I set up these accounts? I'll share a link to Equity Trust with John. I know you work with Equity Trust as well.
Oh, yeah.
So that's an option, but you can do it with a bunch of different custodians. Another resource is a link to John's course. So the entity structures, John, I would love to take the course as well, because a couple of things that you said, I went, ooh, I mean, I have stuff set up, but you know what? And this is probably true for everyone on here, is I set everything up. I set everything up 3 years ago. Is my life different than 3 years ago? Oh, hell yeah. Do I have different assets than I had 3 years ago? Yes. Do I have different life situations? Yes. So a few things you said, I went, oh, now that that's true, I should do that thing. So if you're on here and you already set up your entities and you're doing things one way, but your life has changed since you set everything up, it's probably good to hop in and learn some more. And that's our job as a confident investor, right? To always know, like, my life changed, my investments changed. I need to make sure that I'm continuing to learn and make appropriate choices depending on how I'm changing my investment choices. So,
And the maintenance part will horrify everybody, but you need to know it. In other words, I was supposed to do what?
right. You can also hire some, and like if it's a holding company, I think I pay $1,000 a year for someone to do all the maintenance on it.
Yeah, that doesn't work.
Why doesn't it work?
Because, all right, so the maintenance involves, for example, maintenance involves, really briefly, you probably have a lot of it, the separate bank accounts,
Yep.
good set of QuickBooks,
Yep.
Annual meetings, but the annual
Yep.
meeting, I prefer, because we're setting a narrative.
Yep.
You're trying to persuade someone you've never met and hope to never meet, a judge.
Yeah.
And so part of they do it for you is they have the same template every year that you sign.
It's reminding me to do the things. So I do the
Okay.
things, but they remind me now it's time to do the thing.
Here's my annual meeting for me.
Yeah.
Because again, I'm trying to persuade someone I've never met. I'm going to tell you to do something. People whine when I say this, but then I tell them you're already doing it. You just need to formalize it. I need you to gather your cronies and talk about the stuff you normally talk about. And better yet, do it in Mexico and write off the trip. Or do it in your home, rent the home to the company and get a write-off for the Augusta rule.
Yeah.
And talk to people about what you would normally talk about, but formalize it. Tell them it's being recorded, and then use AI or a VA or both to turn that recording into something that is customized and different. Because here's what most annual meetings are. It's the same form every year with a different date. That for me is not super persuasive. I like to see resolutions. A resolution I define as when the company does something extraordinary. What's extraordinary? You define it. I think I'm up to 100,000 now. If my companies do something that's more than 100, whether it's buy, sell, borrow, lend.
I thought you meant you had 100,000 extraordinary events. I was like,
oh, no. It's 100 grand in money.
Okay. Like you're doing an extraordinary event every second, John.
I like a fake leather book with fake brass rings, which has got all the stuff in it. Returns, P&Ls, balance sheets, formation
Yeah.
documents, operating agreement, resolutions. The biggest part is, I kind of mentioned it, we're just going to go into a lot more detail, is not doing the do to, do from, not doing anything sketch. And also, when we get into fraudulent conveyances, you always want to make sure before you put money into an entity, you are not considered insolvent. We'll talk about that. That's a legal term. And when you take
Oh,
money
yeah.
out of an entity, you don't leave the entity as insolvent.
Right.
Now, you've been around the block a little more, so you may be doing all this stuff. I just get suspicious, automatic trigger, and then hasty judgment, maybe overly so, when someone says it's being done for me. Because what that normally means is there's somebody out of Nevada doing the same templates every year, and the signature and date change a little bit, and everything else is the
Yeah.
same, and it's pure paperwork, and there's no substance. That, if that's the case, that bothers me, because I
Yes.
don't think that would hold up.
Correct. I would agree. But it's someone who bugs me, and they really, really bug me because I really don't like doing it. So they have to really, really bug me.
Yeah, so I don't ever want to be an entrepreneur's accountability coach. Because the same thing that makes entrepreneurs entrepreneurial geniuses
Yeah.
makes it like herding cats. They're horrible at admin. It's just genetic
Oh,
at this point.
it's
I've
awful.
accepted
I
there's
absolutely
it's
hate it.
in the DNA, and it's
Yeah.
deep in the DNA.
Yeah. Agreed. Poor souls. But that's why the entrepreneur has an admin assistant usually, because
Oh yeah.
then
Yeah, no,
then
if
it
you're
can work.
delegating to the proper people maintenance, an awful
Yeah.
lot of that can be done for you. And then they hold you accountable to actually have, for example, a legit annual meeting.
Yeah. John, a question, because we have a lot of, we meaning me personally, my family, a lot of entities, and you said the bank accounts. So every single entity needs to have its own bank account. What if there are not really any transactions for that
Then
LLC?
I have to wonder, what does the entity do? And that's a big one. People push back a lot on that. Look, it's not automatically fatal.
Mm-hmm.
It's a big factor when a court is deciding, is this truly a separate entity?
Mm-hmm.
They have a thing called alter ego theory. And if it's just like a piggy bank where funds get interchanged, and I mean, here it's not even interchanged, the funds just don't exist in that company.
Mm-hmm.
That makes me squeamish.
Okay.
And so on the one hand, it's a pain. I get
Yeah.
that. On the other hand, you kind of see the point of, it's a financial person. You want to put this paper person in front of you to eat a legal bullet.
Yeah.
And you're going to argue it's a separate financial person without its own bank account.
So
Then I
we,
would question, do you have too many entities?
I don't think we have too many. We have, because we have our investments and our funds are different entities, and then we have different management companies for that. So I won't go into myself, but
Well, and then it gets into, do you use series LLCs,
I
which
do
small
not.
people should not use? Like, you can
No.
get away with it. Hedge funds and oil companies are what series LLCs are designed for. I will go into series LLCs. I dislike them intensely.
We don't have that. We're not set up that way.
Cool.
I have a question. So what about this scenario? Because this happens for a lot of our investors. They are investing in a SuGo Capital investment in the name of their LLC, and the money comes from their personal checking account to fund the investment with their LLC in SuGo Capital.
It's sloppy.
So you
And
would suggest, we tell them it doesn't
fatal?
matter to us where it comes from.
No, you don't care. They think they're getting some sort of asset protection. Is it fatal on its own? It could be, not necessarily so. Is it a major factor if someone's deciding, are we going to respect this LLC? Absolutely.
Okay. So you would suggest, because then I can pass on this suggestion, I all the time tell people I don't care where the money comes from, as long as it's not some suspicious offshore something or other. But if it's
Yeah, like
from,
HezbollahLLC.com or
oh yeah. But if it comes from a California bank account and you live in California, your LLC is in California, your person in California, you know, whatever, I don't care. But I can now tell the investor, hey, John Hyre would suggest that you take that money from your personal account and you put it in the account for your LLC, and then make your investment in SuGo Capital from that LLC business account.
if you're not, here's my attitude. If you're not willing to have a bank account for the LLC, you don't have enough that you really want to protect.
Mm-hmm. Yeah.
And I get that it's annoying. I mean, that's why people don't do it. I don't want to do this. It's a pain. I would just rather do the easy way. Okay, but understand you are weakening, maybe fatally, maybe not, but you are weakening the distinction between that entity and you. When you
Right.
pay checks for the entity,
Right.
the whole idea of an entity is it is not you. So when you
Right.
cut checks for it, it starts to look more like you. And
Right.
so again, it's not really, I don't know that it's fatal. I think it weighs heavily on the continuum when they start stacking other factors.
Mm-hmm. Mm-hmm. Okay. Awesome. Well, we're now 2 hours in. We're at the top, so I'm gonna cut us off. Thank you so much, John. This was awesome. I'll give you a recording if you want to do some fun stuff with the recording. I know you're all over social. This could give you some great content. Everyone on here, you'll get the recording. Feel free to share it. The more we can get John's message out to people, the more money people keep. So that's what we want.
Cool.
All
Take
right,
care,
everyone.
everybody.
Thank
New
you.
people, reprobates, everybody, have fun.
Awesome. Bye, everyone.